Right, welcome to part 2 of lecture 18-B. We are doing ratio analysis and are looking at the ratios that are of particular interest to long-term creditors. So we've just gone through the list of short-term creditor ratios. Now we're looking at the couple that would be added, times interest earned and debt to equity. And times interest earned is earnings before interest and tax divided by the interest expense. And so we're looking at this at these numbers here. Income from operations is effectively earnings before interest and tax, and so that's the numbers that we're going to use. Go back down to our particular page here. Times interest earned for 2009 then was going to be $67,000 divided by 24, which gives us 2.79, and in 2010 we go to big jump in net income, or income from operations rather, which should translate into a reasonable sized increase, 3.26 in the times interest earned. So we can say that this is a good improvement, right? What's normal for this industry? Don't know. So we can't really tell in absolute terms whether 3.26 is a good number or a bad number, but we can say that it's going in the right direction, right? And so that would provide some degree of comfort to a long-term lender, but they will probably have some kind of industry average, from other clients if they're a bank or what have you. And then there is the standard debt to equity, and again, that's going to be total liabilities divided by total common shareholders' equity. Or sorry, not common shareholders' equity, total equity rather. Just shareholders' equity. And so 2009 we had $334,000 divided by shareholders' equity of 320 gives you a 1.04. And 2010 we had 441,000 divided by 356, and that gives us 1.24. Zero disappeared. Okay. So again, we would say that this is good. Normally, if there is such a thing, there's kind of like a benchmark rate of 2 to 1, right? So that indicates here, without us knowing any more about what's normal in the furniture industry, that they've got room to take on more debt. And so you would do this after factoring in, like a lender would say, okay, if I'm going to lend these guys, $1 million, I would add the $1 million to their numbers and then recalculate this, and what does that look like, right? And if that looks manageable, if that's kind of inside that 2 to 1, okay, then maybe things are all right. So that's how something like this would be used. So at this point, basically, this again, what we've seen in these ratios suggests that they'll be in reasonable shape to borrow some money over the long term. How much and at what rate and all that kind of stuff, we'd have to kind of sort that out later. That's not really the purpose of financial statement analysis. But there's nothing in the financial statements that jumps out as a reason not to lend to them, is perhaps the best way to look at it. This shouldn't be the answer of, yes, go ahead and that's that. But there's no reason to put the brakes on at this point based on the financial statements. Still have to ask some questions, still have to do some digging to get the final answer. Okay. The third and final perspective is the common shareholder, and again, they're going to look at things a little bit different. They're interested in obviously income over the long run, but primarily because that's going to return value to them in one of two ways, or even both. One, it's going to drive up the share price, and they can then sell. Or two, it's going to come back to them in the form of dividends. So it'll provide enough after-tax cash to the corporation that the corporation can then turn around and pay out dividends, which will compensate the shareholders for the use of their cash. So ratios of interest then: earnings per share, price to earnings ratio. This allows you to compare kind of earnings per share against other stocks in the same industry. Dividend payout, how much of the earnings get returned to shareholders in the form of dividends. Dividend yield ratio, how much dividend do you get paid for every $1 that you invest in a stock. Return on total assets, so that is going to be the sense of how efficient the company is at using the assets that it has. Return on equity, again, how good the company is at generating returns for shareholders. This will incorporate the use of debt, whereas this we kind of normalize away the debt by adding back this interest expense, so that we're just looking at how effective they are with their assets and not factoring in their capital structure at all. And then finally, the book value per share. Okay, so let's go and calculate these guys and see what they can tell us. So earnings per share, we have 2009, and that's going to be net income minus preferred dividends. Net income of 26,000. There are no preferred dividends for SOFAWorks. Divided by 10,000 shares, average number of shares outstanding for the year, and that works out to $2.60 per share. And 2010, we have 48,000 minus 0, no preferred dividends. Again, average number of shares was 10,000. That gives us $4.80 per share. So that is a very healthy improvement. We would say good growth. We like that. We like it even more if we bought the stock in 2009, because surely its value has gone up, or shareholder value has been increased in some way. Price to earnings. So part of the problem, though, is you can't really compare earnings per share between companies, right? Because it's going to be a factor of what the share price is, how many shares they have outstanding, and all that other kind of stuff. So what we can do is look at converting that into a much more comparable number by simply taking the market price of the share, in this case $35 for 2009, and dividing it by the earnings. And that will tell you for every dollar of earnings how much it costs to buy the share. So 13.5 means that in 2009 you paid $13.50 for every dollar of earnings that the company generated. So you paid that in share price. And so now let's look at 2010, and the share price has gone up to $50, and the earnings per share is $4.80, but the price to earnings, interestingly, has fallen. Decreased. Does that mean that the stock in 2010 is now undervalued? So, in other words, in 2009, for every dollar of earnings, the shares cost you $13.50, and in 2010, that cost has gone down to $10.40. So, this number is going to have significance when compared with what other stocks in the industry were doing, but it's cheaper to buy this stock now, to buy the earnings generated by this stock now, than it was in 2010. Why? Don't know, but let's keep looking. Dividend payout. So this just looks at what percent of the earnings actually gets returned to shareholders in the form of dividends. So in 2009, they paid $1 per share, and they earned $2.60 per share. So that meant that they paid out 38% of their dividends. 2010, they bumped the dividend up to $1.20, but the earnings went way up, so the dividend payout actually fell. And that might have something to do with the price-earnings ratio. In other words, it's possible that shareholders are saying, well, your dividend didn't keep pace with your growth in earnings, and so we're going to bid down the share price. But that doesn't make a whole lot of sense, because there's nothing stopping the company from bumping the dividend up in the future, and then things would be sort of back in line. So a more useful number, though, from the standpoint of the common share investor, is going to be the dividend yield. And this is going to say, look, if I put $1 into this stock by buying it, how much am I going to get back in the form of dividends? And so for 2009, that was $1 of dividends divided by the market price of $35, or 2.86%. So that's the rate of return from dividends. And 2010, that went up to $1.20 over the new market price of $50, 2.4. So the actual dividend yield fell. And maybe this is a more concrete reason for the bidding down of the price to earnings ratio. The fact that the share price now is high enough that the dividend is less attractive, right, than it used to be. So the question then is, as a potential common shareholder, will dividends increase? And you can ask the company, what are your plans for increasing dividends, assuming this, that they're small enough and you're big enough that they're going to return your phone calls, right? Or you're at the AGM and you're talking to these guys or something like that, right? Okay. Return on assets. So again, here what we're talking about is the net income, but adjusted to remove the effect of capital structure. In other words, to remove interest expense. So we're going to add interest expense back to this number. So we're going to look at the net income of 48,000 plus the interest expense of 34,000 divided by the average total assets, which are 797 plus 654 divided by 2, and that gives a return on assets of 11.3%. And again, I mean, it'd be nice if we had something to compare this to, but we don't. So, we've got this 11.3, and next year we should recalculate this and basically look at the trend of sort of where this is going, or see if we can dig up some industry averages to compare that to. Next ratio we're going to look at is the return on equity, ROE. And again, this is net income minus preferred dividends divided by the average common shareholders' equity. Oops, where did my R, O, and E go? And so we're looking at $48,000 worth of net income, no preferred dividends, divided by the average common shareholders' equity, $356, plus 320,000 divided by 2. And that works out to 14.2%. Is that good? Who knows, right? We need to compare it to something, and we don't know. And then the last number that we're going to calculate is the book value per share, and that's the common shareholders' equity, so total shareholders' equity minus preferred equity, if we had some, divided by the number of common shares outstanding. And so for 2009, we have $320,000 minus no preferred equity, so minus 0, divided by 10,000 shares, and that works out to $32 per share. And 2010, $356,000 minus, again, 0 preferred, divided by 10,000, and that works out to $35.60 per share. And we will carry on our discussion in part 3.